Hello and welcome to the latest in our Meet the Manager series. Today we're going to look at an investment strategy that is very contrarian in nature and one that has been employed to very good effect by the Schroder's UK value team. This is a team based in London. They manage over 5 billion in assets, and we're joined by one of the team today, Mick Kirrage. Nick, thank you very much for giving up your time.
Not at all.
Maybe if we could start with the investment approach that you employ and just maybe why you think it is so effective.
I think it's so effective because it's so easy to repeat over long periods of time, because value investing is, at its heart, investing in the cheaper parts of the market which statistically outperform over longer periods of time. And I think that some people look at that and think, is that a trick? But it's not. It's based on something that reoccurs for a very simple reason. This valuation phenomena where cheaper stocks outperform reoccurs because whilst everything changes in finance, the economics and the politics, the regulation, the thematics, everything is constantly evolving and changing. One thing is staying absolutely consistent, just doesn't change at all through the whole of the history of finance, and that's humans. Our behaviour is very consistent. We become fearful, we become greedy, and those swings are very systematically exploitable, and that's what we do as value investors, and that's why we have great confidence in the approach looking forward, because we believe that humans won't change. It's the only constant that will remain, and therefore we can use that to invest for the long-term benefit of our clients.
Okay, and at the heart of your investment process is this concept of judging the valuation of a company based on earnings over a long period of time, over a number of cycles, rather than the profits earnings today or next year. Now, if you take that concept and just apply it to the stock market, it's been a very effective buy signal over a very, very long period of time. Why doesn't everyone use that? Why is it there's only a relatively small number of teams that we're aware of who employ this process?
Well, as you highlight, it's very, very powerful, because mean reversion, this idea that there is a huge cycle to lots of things that are going on, profit margins and valuations and economics, GDP, whatever it is. Most stuff in finance, the vast majority of stuff, is mean reverting back to an average. So why isn't it that more people are using that to understand where we are and therefore, extrapolate and say, well, knowing that things will mean revert, I can employ that. And particularly with valuations, with such a powerful, demonstrable kind of 100-year track record of this working, why isn't everyone doing that? And there's a very, very simple reason, because it's just not that easy. Psychologically, this is absolutely brutal, because it doesn't work in every short period. There can be prolonged periods, months, sometimes years, where this is very, very out of favour, where focusing on the cheapest part of the market is just not the part of the market everyone's getting excited about. The tail end of bull markets is a very good example of where the party is in full flow. There is a lot of kind of exuberance going on, and focusing on cheaper companies can often lead to relatively poor returns versus the market. And people sometimes say it's broken, it doesn't work anymore, it's clearly something has changed. But humans don't really change, and over time we come back to this approach, and that's why we take such a long-term investment horizon. That's why we invest in stocks for on average 5 years, because it requires that long-term investment horizon to truly get the best out of the approach.
Okay, that makes sense. And if you take this kind of broad approach where you just look at the market in terms of its longer term profit stream and value it on that basis, if you look at it now, what does it tell you about the market today in terms of how cheap or expensive it is, and how is that influencing your decision making?
It's a very good question, and we do like to think of it in those long-term contexts. So we're individual stock pickers, and we look at the valuations of individual stocks, but clearly we're subject to a universe of stocks that is the market as a whole. And that average valuation tells you quite a lot about what you can expect from investing in UK equities over the next 5-10 years. The market is back up at all-time highs in terms of the FTSE numbers that people will see. But actually, if you scratch beneath the surface, a lot's changed in the 15 years since we first got to a FTSE level of 7,000, all the way back in 2000, the year 2000, kind of slightly frightening period of time over which the market has tracked sideways in quite a volatile way. But underneath that, many companies have made significant progress in the 15 years. Profits have grown, the economy's moved forward. Not in a straight line, quite a lumpy way, but it has moved forward, and therefore valuations today are not nearly as extended as they were the first time we were here in 2000 or the last time we were here at the peak of the market in 2007. So that's a positive thing. However, a note of caution, that is different from saying things are cheap. and they're not. Valuations are today above their long-term 100-year averages, and that should strike a note of caution for most investors. They're not extraordinarily extended, it is not warning bells going off, but neither is it a fantastic buying opportunity. However, within that, as stock pickers, there are some very, very cheap stocks and companies that we can invest in individually and build a portfolio of those cheaper companies. And that's what gives us reasonable confidence that looking forward, we can continue to extract the outperformance from the value approach that we've seen over the last 100 years, over the next 5, 10, 15, 20 years going forward.
Great, and one area in particular we've noticed you've started investing in that you haven't been for a while is mining. So you bought your first mining stock in a very long time.
Yes.
Maybe you could just add a bit of colour as to what's attracted you back into that sector.
Well, the thing that's attracted us back is plain and simply the valuation. But one thing I would say about commodity-related sectors is that it's the stocks within those, there are some very, very dramatic differences in the valuations, and some stocks have performed much, much worse than others, and those are the ones that we're looking at. I think there's still a reasonable amount of optimism that despite some of the weak negative headlines that we've seen, some of the weak commodity prices, some of the valuations of some of the bigger businesses have held up quite well. But as we look individually at companies, there's reason to believe that today we should be thinking about investing and starting to invest in some of those businesses, build positions. We do that over long periods of time. We see no short-term rebound in mining. When the party has been going on for a long period of time in mining, commodities have been high, and a rough rule of thumb is that the bigger the party, the worse the hangover. And when things get out of kilter, commodity prices can remain depressed for very long periods in the same way that they were elevated for long periods. So we don't necessarily forecast a great recovery in that. However, there is a great danger as an investor that you confuse the macro with the investment opportunity. For much of the last 5-6 years, the macroeconomy has been very poor in the UK, but it's been a phenomenal opportunity to invest in stocks and shares. You've made 100% from the market. So the macro, focusing exclusively on the economics, would have led you to make the wrong decision. With mining today, we need to be careful that people don't extrapolate a weak commodity environment and say that means that nothing is an attractive investment. There are some, we're starting to pick them up. We think it's a very long road and we're at the beginning of that road, but we are looking to take advantage of that for clients.
Okay, well, that's helpful. And maybe we just finish with a question that our clients are always keen to hear about, which is alignment of interest from fund managers. Would you care to share with us the extent to which you and the team are personally invested in the funds? Very
significantly, and I'm not going to share the number because that would probably scare my wife. But the reality is that we believe in eating our own cooking. It must be right. We have an expression that we always use when we're talking about investment, and that is, do what you would do with your own money. Do not make decisions that you think, well, I would do that for clients or for a portfolio, but I wouldn't do it with my own money. We align our own interests. We do that with investment, but we also do that with our thinking. We think about things in absolute terms, not relative to a benchmark. We think about absolute safety, absolute position sizes, and in absolute terms, is this worth more money in the future? Not will it beat an arbitrary benchmark? And when you start to think about things in those absolute terms, it makes a huge difference to how you perceive, how you will make money for your clients and for yourself, which is why we invest over the longer time period. So we absolutely believe in that, and we certainly invest heavily in our own funds.
Great. Thank you very much, Nick. Hopefully that's a bit of interest. If you'd like more information on how to access this particular investment approach, I would encourage you to speak to your broker. So we have a couple of the funds run by the Schroder UK Value Team, the Schroder Income Fund and the Schroder Income Maximiser Fund, which are currently on our buy list. Thank you.